I am here with Rick McCullough, fellow franchise broker, new colleague. I'll say we're getting to know each other pretty well. Rick and I are talking about franchising as an investment opportunity, and he tends to be the smartest guy in the room when we start talking about this. So I will let Rick introduce himself and his strong background.
Thank you very much, Lisa. As Lisa said, I spent nearly 40 years in business. I come from an accounting consulting background, then became a controller, then a financial officer, actually an investment banker for about 6 years, and ended my career as a senior officer running corporate boards and CEO of companies. And then I bought a franchise. And I look at the franchise, I think differently now that I've become a franchise consultant. What was surprising to me was that, to me, it's very compelling why franchising should be on people's radar screens as an investment strategy. But I find that a lot of people don't understand why. So what Lisa and I are trying to do is help take some of the financial fundamentals and apply it to franchising to help people.
Yeah, and I think this will be a good series for us to have, Rick. We both are going to approach things from a similar perspective, and that obviously we're pro-franchising as an investment. And I think the conversations that we have moving forward too will hopefully educate people to understand that we're not saying abandon your other investment strategies, but we are saying franchising as one diversification option in a portfolio makes sense. And so I think that that's probably how our worlds will collide, right? You're going to approach it from that investment background, an investment banker background, and I'm going to take it like this. I agree. The franchise world is prime for investors. I've worked with several people that have become very wealthy in the franchise space, and I'll say many wealthier, right? And that's okay too. So, all right. So talking about this and our backgrounds a little bit, again, my name is Lisa Welko. I have been a franchise consultant for over 10 years, in the franchising space for over 20 years, franchise owner, franchise development. I own franchises. This is what I eat, breathe full-time, all day, every day. So, and you talked a little bit about your background, Rick, and I think it's important to say too, franchise owner, that's kind of where all this came
That's
to
right.
in your world. Is you drank the Kool-Aid, we like to say, right? All right. So let's talk about this a little bit. Let's talk about kind of the different talking points around why we agree that franchising makes sense, not just for the cash flow now perspective of maybe buying yourself a job or buying a business. Let's talk about the investment strategy and what you're pointing out to the investors that you're working with.
Yes, and what I'm going to focus on in this first episode, as Lisa said, we're going to do several where we'll share more and more specific observations. But I'm just going to talk about the financial fundamentals associated with franchising. And what I would say is that most people, when they go through their lifetime and they focus on their savings, they start primarily with focusing on household expenses, building emergency funds. They begin to save money for their children's college education, for their retirement. And so they progress through phases. But most people don't focus on business ownership until perhaps very late in their career. Most people, in this next slide will show you that some of my observations are most people don't think of young people owning businesses. They think that businesses are for wealthy people. And true, it's easier to fund a business when you're at that stage in life. But what I'm going to try to show you is why it's important to even look at it early in life. Traditional thinking, again, is that rich people can afford businesses. But if you're trying to seek wealth accumulation, the way we define wealthy is that you can live comfortably in your retirement, basically maintain your standard of living, but then also leave some money for your heirs. And depending on how frugal a person is in their lifetime, the sad thing is that most people do not realize that corporate and personal retirement plans probably aren't going to accumulate large enough to meet their retirement needs. And it boils down to a couple of factors. First of all, the trend started in the 1980s when corporations moved away from defined benefit plans. And when that happened, basically the corporations and the government kind of transferred the responsibility for your retirement accounts to you personally. But what's happening is that if you set up a traditional plan and you invest in stocks and bonds, that long-term rate of return on stocks and bonds of 6 to 8%, sadly, is probably not adequate to build the balances that you're going to need. And what people need to do, and it's surprising, even some mid-career or late career people need to look at ways in which they can increase their contributions to retirement plans and earn higher rates of returns. Not excessive rates that take on a lot of risk, but more moderate rates that will grow the funds larger. So my position is that even young people should consider business ownership.
And it's amazing how many people that we talk to, I know every single day, in their mid to late 50s for sure, even early 60s, saying, okay, this is where I'm at. This is where my 401k is at. My retirement is here. And now I'm understanding I need to have more money. I want to have more money, and I'll just call it to pad that nest, right? But I think it's a good conversation for people to understand. It's not a one or another type of thing. You don't have to stop your stable income to do a high risk, buy a business, make $1 million investment. You can do both if you're strategic with it. And there's businesses out there and there's ways out there to help you. And most likely is going to beat the market. And it'll do it in a shorter amount of time, which is what we've talked about, is that if you're going to invest little bits a long time, it can add up. But when we're in our 50s and 60s, we've got to have that add up a little quicker. Okay, talk about this one. I think it kind of goes to the point you just made, right?
Yeah, and one of the observations I'm going to make over the series of this educational webinars is that the end of my career, I was an executive officer in the energy space, and we saw private equity firms investing in energy very extensively. And I'm going to try to draw those parallels back to franchising, and you that might be either mid or later career people, or even in this chart will show young people. But what this shows is on the left-hand side, it shows the income level that the person has obtained in those first two columns. It shows the middle column is the amount that they need in retirement to maintain their lifestyle. And you can see it's roughly 10 times your annual salary is what you need. Sadly, the right-hand column shows how chronically underfunded pension plans are. And I tie that back to my observations earlier. It started in the 80s, and the problem that the companies had is they could not fund the retirement plans adequately in the stock and bond market. And now that's an obligation that really individuals have. And so we're not trying to depress people. We're simply trying to bring it to your attention. And so what this chart suggests is that you need to look for ways in which you can contribute more on a tax deductible basis, higher levels, and you probably need to earn higher returns than the 6 to 8%.
Absolutely. Talking about the rule of 72, one of Rick's favorite things to talk about.
Well, this is just, again, a financial concept that I'd encourage you to become familiar with. And essentially, it just is a quick way to calculate how much your fund balance is going to grow to. So you take the number 72, and in this bottom line, that blue line is showing the money accumulating at 5%. The gold line in the center is 8%, and the blue line at the top is 12%. So the way you would do the calculation is you take 72 divided by the 12% in this example, and that money doubles every 6 years. And so if you're investing for retirement over a 25 or 30-year period, the number of times that the money doubles, and you can see it in this graph by how dramatic that 12% line really turns up. And what's happening is you're earning interest on the growing interest balance. So every time that interest is paid, you're being paid interest on that original principal and the interest. So this is compounding interest. So just to put some numbers by this to illustrate this, if that beginning balance, this is assuming no more money is put in the account. If that
Okay.
beginning balance was $50,000 on the far left, the 5% line would grow to $125,000, which is not bad over 20 years. But the 12% line would grow to 600,000, 4 times as much. So the same investment, just illustrating how important the moderate interest rate is and the number of years that it compounds is. Now, we're not suggesting that you should go out there and try to earn 12%, but it's illustrating how important it is to save early, save as much as you can, front end load it, and earn a moderate return to build your balances.
All right, let's talk about this one.
So what I think is very interesting is, what do the wealthy do? And this chart that I borrowed from a financial advisor, it shows different portfolio sizes, and it shows the dark blue is showing the percentage of the investment that is in business assets. So if you look at the top of the chart, this is a $10,000 portfolio. And most, like you would think, most of the investments are in stocks and bonds. The top blue, the business investment, is extremely small. But look at how, as you progress in the size of the portfolio, in the middle of the chart, the $1 million portfolio, it's probably more like 30% of the total portfolio. In the bottom of the chart, the $1 billion portfolio, it's almost 70%. So I think obviously the $1 billion investor probably has investments in larger companies. So that's part of it. But you can't deny the trend, and you can't deny the fact that they're putting more and more money of their money in businesses. And you can ask why. And what I will tell you is, I think it's because that's where you can make your money. That's where you'll see higher rates of return. And we'll illustrate that as we go forward.
Well, we've talked about this too, Rick. One of the reasons is so simple that we forget about it, but it's because you have more control over that.
That's
When you're the business owner, you get to control things. No, you can't, some things you're obviously dependent on the market and dependent on the cost of a tomato or whatever is happening, depending on what kind of business you're in. But when you own that business, you're controlling the investment. You're looking in the mirror and saying, I have to depend on me, not some portfolio manager, not the SBA, not the feds who are going to change the rate. You get to have control over this investment. And I think that we have talked about this ad nauseum. It needs to be said. This is the one, possibly multiple parts in your investment portfolio that at the end of the day, you can control. You get to pull the dials more than any of your other investments.
That's absolutely right.